So essentially, what I what I kind of specialize in, as Andy has said, is the 18-year economic cycle. Now, you might know it through various sort of guises. Those who study GAN might talk about the North Node cycle, um, or the Saros cycle, or various other things. We can come on to kind of correlations. I'm really talking about it slightly from a fundamental economic point of view. And I know that we're cycles analysts and some of us are technical analysts and so on. And we don't necessarily always kind of relate what we're seeing back down to fundamental kind of laws of economics. And that's fair enough, because ultimately all we need to know is, if you want to make an investment call, you just need to know which direction the markets are going to move in. You don't necessarily need to know why it's happening. But nonetheless, as Andy mentioned at the start of his introduction, I came to all of this kind of knowledge and interest and study when my family's business went through pretty difficult times in 2008. And that was because banks had, called in loans from small businesses, and, for small businesses that are reliant on bank credit for perfectly, normal reasons, it was almost terminal. And it's taken us the best part of a decade to see through some of those problems, and they're still to a certain extent with us even now. And so I thought it was kind of really kind of impossible that we weren't given some advance warning about why these things took place. And I thought, I'm going to try and understand what went on and what we could do to be prepared, because when I say prepared for the next one, because it seemed fairly obvious to me that there was going to be a next time, and I didn't want my family to experience the difficulties that we had in the aftermath of 2008. Yeah, so I think that's kind of where I started. Subsequently, have come across a lot of research. Actually, I mean, it's a fairly niche thing about how these things work. And I've, as Andy said, I work with Phil Anderson. I work with a few other people. I work with some businesses on a consultancy basis and so on, to really try and help them navigate the ins and outs of the economic cycle, which is ultimately responsible for all the financial crises that we see periodically in our economies. And once you understand that, I think you can make some fairly prescient forecasts. And if any of you are familiar with my work and Phil's work, I think you will have seen some of that. And just to kind of reiterate how wrong people get the sort of ebbs and flows of the economy, I've got a few slightly provocative slides. I've sort of started this by saying, does anyone really know what they're talking about? I mean, and since the beginning of 2023, well, actually since late 2022, when the UK gilt market supposedly almost blew up. Actually, it didn't, but there was nonetheless a lot of panic for a couple of days. We've kind of been on the sort of precipice of this idea. I mean, maybe it's dying down a little bit in 2024, but this is quite different to where we were this time last year. And we started last year with saying it's going to be the most anticipated downturn ever. So it was virtually guaranteed that the economy would be in recession, that we'd have a major sort of crisis of some sort. This is from Bloomberg. Most anticipated recession in US history, which of course has not happened. So what's going on there? The World Gold Council is always sort of keen to use opportunities like this to plug their strategic assets and so on. I mean, clearly, something was virtually guaranteed to happen. People didn't really know why it hasn't happened. I've not seen any sort of useful explanation proffered as to why they felt they got it so wrong. We got to March of last year, we had the Silicon Valley Bank crisis, the largest bank failure since 2008. Clearly, financial crisis was about to come, and we all know from 2008 what financial crisis means. Again, we didn't really get that. Then we got to the summer, Morgan Stanley saying commercial real estate, and a lot of these small banks that was experiencing problems had overdone their lending to offices and so on. Of course, with working from home and so on, commercial real estate was really under pressure. And according to this, and this was by no means unique commentary, things would crash harder than the great financial crisis. Now, well, I'm not saying that office commercial real estate is something that you want to be invested in at the moment, but certainly hasn't been in crisis mode in quite the way that it was that people anticipated. Now, what is it about all of these things that people get wrong? Going back, and it's not just kind of post-COVID, there's a lot of big adjustments in the economy and so on. And people could say, well, actually, all the stimulus, all the kind of yield curve control, all this thing has, pushed economic relationships into a different mode. And then the, Federal Reserve panicked and raised interest rates from 0 to 5% in a very short space of time. Maybe that's broken something, and therefore it's understandable that people don't necessarily kind of can anticipate the ebbs and flows of the economy. But it's not just a new phenomenon. I've been studying this for now 15 years. My friend Phil has been studying it for longer. And you get these things periodically. Ray Dalio in 2020 said cash is trash, you should be fully invested. Trump was talking about an economic boom, the likes of which the US had never seen. We all know what happened then. It wasn't entirely down to COVID. The global economy was slowing. They clearly had missed something. It was the panic that exacerbated, the COVID panic exacerbated what might have been already a slowdown. In 2019, everyone was downbeat, and this is, Davos is always a good place where the great and the good get together and provide a commentary on what they're thinking, which tends to set the narrative each year. 2019, very downbeat. They talked about, technological developments taking away jobs. They talked about people being very angry. They talked about trade wars and so on. And of course, we know what happened in 2019. The markets were up all year, but maybe not just politicians and their sort of the ways they talk. You get some really smart people talking about, and this was back in 2014, hyperinflation because of all the QE, and that was actually precipitated the gold crash into 2016. Ben Bernanke, of course, great moderation. I put this up because this is kind of the equivalent point in the last 18-year cycle, talking about the great moderation, decline in macroeconomic volatility, which in other words is code for I've solved the boom and bust cycle. We had similar things in the UK around that time. Gordon Brown, who was in charge of the economy, said he'd solved boom and bust through his prudent financial management. And of course, we know that things did go up for a couple of years and then came crashing down. And Ben Bernanke had to say during that period that September and October of 2008 was the worst financial crisis in global history, including the Great Depression. And he should know, being a student of the Great Depression. Now, clearly, people are missing stuff. I mean, it's not just them. It's not just politicians. It's not just big fund managers. I think we've had 18 months of people being very certain about what was going to happen. It hasn't happened. So what's going on? What is it that everyone's missing? And that's really the subject of what I want to get onto. Very famously, the Queen went to the LSE. Andy mentioned the LSE at the start of the presentation. 2008. This was just about, I believe, November 2008. It's about 7 months after Lehman Brothers collapsed, and the Queen was opening a building. And she went to the LSE, and she'd sort of wanted a briefing on what the hell was going on to the UK and to the global economy. And she got a presentation, and they talked about, there's lots of imbalances. Chinese are saving too much money. It's pushing global interest rates down. It's inducing speculation. We have a financial system that's interrelated. There's regulations, but no one's got oversight of the whole system. And therefore, no one really knows how all of these things fit together. It's the kind of usual explanations that you get. I went to a talk at the Systemic Risk Center in LSE last week, and it's very similar types of conversations going on, i.e. these things are really complicated. There are new instruments. There's, Bitcoin, there's crypto, there's, leverage built on that. We don't know how this is all going to play out. And I think while there are certain novelties to the current era, there's obviously AI as well. I don't think that anything that has happened is particularly such a leap change in economic development that we haven't seen something equally impactful in the past. And I talk in my book about, the impact of the railways. To my mind, a much more significant technology than potentially AI in relation to where the humanity was before the railways. So maybe you can park that and we can have that kind of conversation in a second. So what are they missing? So very, very simply, and I'm going to outline the contours of the 18-year cycle very briefly. We can go into more detail during the Q&A. The proposition is that there is a very regular 18-year cycle, and you see it most clearly in the land market, in the property market, but actually it's an economic cycle. And so what this graph does is it shows the progress of the US in terms of its land sales. So as you know much better than I do, after 1800, when the 13 states of the US ceded their sort of what do you call it? Their rights to Western lands to the federal government. The federal government then proceeded to sell off the land. You went out into the frontier and bought, I don't know, whatever you wanted for $1.60 an acre, and so on. And the progress of land sales shows that actually things would go sort of fairly steadily for about a decade, and then they would crescendo into a peak in 1818. And after that, you would get a major drop-off in activity in terms of land sales. But actually, if you read the historical record, you found that actually it was a kind of fairly significant banking crisis and an economic recession. And actually, what it was that, you know, a lot of the activity in the run-up to the peak had been built upon people borrowing money to speculate in land, in property, and so on. And the economy kind of supported that for a time, and then it could take it no longer, and the entire thing collapsed. Then things would recover a few years later. They'd go steadily into another crescendo. And the second one was in 1836. And then you had a major depression after that, the depression and crisis of 1837. Andy, I know, has written about that quite persuasively. And it was a very significant, probably the first really significant financial crisis in US history. But then things recovered to another peak 18 years later in 1854. And again in 1869 was the peak. 1873, 19 years later, was the crisis. 1888, a couple of decades later, that kind of things bubbled on around the top, things came down, then we had the major depression of 1893, and so on. And so for the first 120 years of US history, until about 1923, when frontier was closed, you had these very regular 18-year cycles of boom and bust. In the aftermath, there was a major financial crisis. Then in the 20th century, we had probably the most famous boom of them all, the Roaring Twenties. The land market peaked in 1926. There was various factors which led the stock market to have another couple of years. The land market was doing nothing. Agricultural market was in depression for most of the 20s, but the commercial real estate market, because of tax incentives, because of low interest rates, and because of the enormous amount of money that had been created in the 20s, pushed the stock market up for another couple of years. And then we had the major crisis, which presaged the Great Depression. And so on. After that, things were interrupted. The Second World War, of course, when you're fighting a total war, things aren't going to be quite the same. But after about 1955, 1956, things started to reset. And on the next slide, you see a graph of property prices in real terms in the UK and the US. And so things reset in 56. We had a peak in 1972 in the US, in 73 in the UK, and then a major financial crisis, which in popular imagination and amongst actually some fairly educated financial commentators was entirely down to the oil shock of 1973. Not at all. It was a declining property market that was pushing the economy into recession, that was then exacerbated by the oil shock, which created the problems of the 70s. But we would have had a fairly significant recession, if not depression, in the absence of those geopolitical events. Nonetheless, things recovered in the late 70s up to the boom of the 80s, to a peak at around 89, 90 in the UK. Very famously, the biggest boom and biggest bust was in Japan. Again, very much property-led, and so on. And it was so severe in terms of their crisis that it's taken pretty much 20 years for them to get out of it. By about 1993, the US was recovering. You know, Clinton, it's the economy stupid, it's all that kind of stuff was going on at the same time. We had the dot-com boom. We didn't have a crisis after that. That came down. We had, you know, stimulus and so on. It pushed the economy into new heights in the 2000s, to peak in 2006 in the US, 2007, and then of course the global financial crisis. So pretty much for the entire history of the United States, and you know, very significantly for all of modern UK history and the history of other countries in Europe and so on, after they've been independent or established the current format that they have now, countries joining the international system like Japan after the Second World War are exhibiting very much these 18-year cycles of boom and bust, very much linked to the land market. Now, it's not just a case of waiting every 18 years for a major recession. If you study each episode in detail, and it's set out very well in my friend Phil's book, The Secret Life of Real Estate and Banking, and also in my book, The Secret Wealth Advantage, you can discern a sort of fairly regular pattern within it of 18 years on average. And actually with not much variation. And sometimes it runs a bit longer to 20 years, sometimes it's a bit shorter, but really that one of the uncertainties about all of this is that we don't properly measure the land market, and that's where you see the cycle most clearly. Nonetheless, the 18-year period is divided into roughly 14 years of expansion and 4 years of peak, crash, and recovery. And those 14 years of expansion themselves are divided into roughly 2 7-year halves, interrupted by a mid-cycle recession. And the mid-cycle recession tends to be much milder and shorter than the end of cycle recession, which actually, in technical terms, is probably an economic depression. And this is when the most significant problems in the banking system, the most significant reductions in output, the most significant problems in kind of social relationships and so on occur. So the first, I've divided in my book into sort of 4 phases. The first phase is the recovery and expansion, the recovery out of the prior cycle lows, and it expands for 7 years. You then get the second phase of mid-cycle recession, as I've said. You get the second expansion, which is very much more obviously land boom, which finally in the last couple of years accelerates into a bit of a mania. And I will go through some of the telltale signs of a mania. And then that leads into the major crash and requires a major bank bailout and so on. In this, and this might be slightly more closer to your heart in the sense, I don't know if you're property investors, but I think you're all stock market investors or traders. In this chart, all I've done is I've taken Dow data back to 1800. I've chopped it into roughly 18-year segments. I've kind of averaged it out. And what you get is a relatively similar pattern to the previous chart. In other words, things start slowly, they expand through the first half of the cycle. You have a mid-cycle slowdown. It either consists of the markets going sideways for a couple of years or the markets coming down pretty hard and going straight back up again as they did in 2020. That leads to the second half of the cycle. The stock market tends to be even stronger in the second half. It almost invariably gets to major new highs. I think the 1860s was the only one where it didn't, and that is probably explained by the US Civil War. But otherwise it goes into all-time new highs, and then you get a major peak and crash, and you can't really see it properly because of the scale and so on. But and also because I think I had to exclude some data just to kind of make the sort of segments fit. But the median fall in the Dow Jones over that period is 48%. And, obviously if you're invested in particular sectors like the banking sector, property sector, the downturn at the end of the cycle is even greater. So these are major significant stock market events. Often take several years to sort out, several years before if you're invested all the way through it, and people usually sell out at the bottom. If you're invested all the way through it, it takes several years for you to get back to where you bought in, presuming that you bought in at the peak, which, of course, as we know, investing is an emotional game and people tend to get sucked in at the peak. This sets out some of the past forecasts. I mean, just to show that, Phil and I consistently put our kind of our forecasts out into public, and this is sort of Money Week magazine, which is the largest financial publication in the UK, to kind of set out some of the, how the cycle works and what we see going forward. Now, the obvious question is, where are we headed? So the current cycle started post GFC around 2011, 2012. There's never one single day when a cycle particularly starts. It's a process. You've got to get through the problems of the last cycle. The banking system needs to be put on a sounder footing. The US and the UK did it much more quickly than, say, Europe after 2008. And so it appears that the US started around late 2011, maybe early 2012, when the land market bottomed. After that, you would have expected 7 years in, 2019, 2020, for there to be a mid-cycle recession. You can finesse it a little bit using other cycles as you get there close to the time. We definitely had a pretty short and sharp recession. in 2020. It wasn't all COVID induced. There were very many signs that the global economy was heading into some kind of slowdown in 2019. Then, nonetheless, stimulus worked very quickly. They overstimulated, clearly, because I don't think they realized what they were dealing with in relation to the pandemic. But nonetheless, if 2019 is the start of the mid-cycle, it would then put you in relation to the peak of the cycle around 2026. And what you notice if you study your history is that very similar things happen at each phase of the cycle. I outline all of that in my book. I break the cycle down into several stages, and I say, here's what happens at each stage based upon a reading of history. Now, just to take where we are in the cycle and sort of kind of go through a little bit of that. And some of this relates to markets and things that you might be invested in. And sorry, the yellow dot should be a little further to the right. I needed to update this chart. So we are sort of on the cusp of the really frothy period leading to the peak in 2026, which is the kind of forecast date for the peak of the cycle. So you get looser monetary and fiscal policy. We've certainly had that. You often get spending for public works, i.e. infrastructure. We certainly had that. And I'm not just talking about the US, I'm talking about globally. This brings and induces a commodities boom because demand for raw materials and so on, and trade is expanding and other things. And big countries are sort of vying to compete for various access to raw materials. You get the era of very easy money. Now, you might say we've already had that and we're tightening. What I really mean is really profligate bank lending, and we're not quite seeing that yet, but you certainly see the signs. Lending is particularly lending at 5% or whatever it is very lucrative for banks, and they're really trying to find ways to expand their balance sheets and so on. And where they're not successful, non-bank lenders are coming in. So it's really an era when people are really encouraged to borrow as much as possible. And one of the very telltale signs of a peak is the fact that you get a series of announcements about the world's tallest, longest, largest, deepest structure. And that is partly because it brings together three of the things that you always get at the peak of the cycle before a major crisis. And that is high land prices, such that building higher is needed to make the site pay, easy credit, because of course you need to borrow a lot of money to build these things, and a sense of optimism, hedonism, even that the business case for such a building makes a lot of sense. Certainly not the sort of thing that would get past run up to the run up to the peak.
Sorry,
and then after that, sorry,
I was just asking a question, if that's okay.
Oh, sorry. Yeah, sorry, I didn't hear you.
Yeah. This era of very easy money. It's interesting what's going on with private credit right now. This whole movement of private credit, right, that didn't really exist before, of the lending kind of moving out of the banks and into the BlackRocks, et cetera. Any comment on that?
Yes, it's a repeat of history. If you go to 1990s, 80s Japan, you had the sort of conglomerates, you had the sort of industrial companies, all of which were allied to one of the major Japanese banks that did a lot of lending. But really, in the couple of years before the peak, it was all the non-bank lenders that got in there. They weren't bound by the same banking regulations, and they had a lot of surplus cash, which they'd raised from private investors. And they were really pushing money into the market such that banks, if they wanted to keep up, had to find ways of getting around the regulations. I see what's going on with BlackRock and others having the same impact in this cycle as it did then. And there were certainly things in the 2000s which really pushed lending into overdrive. New structures, ways of originating the loan and then shifting it off the balance sheet and so on. So it's very much a product of the present era.
Yeah,
I think the key thing is the scale. So it's not like people invented securitizations in 2004. They were around as a financing vehicle since probably the 70s or 80s. But it's the extent to which people push that at scale once you've had several years of the cycle that I think is really the key point. All right, final kind of slide. So world's tallest building marks the peak. This is the Burj Khalifa. in 2010. They're always open in the crisis. This is the Shard in London, and you'd be familiar with this, which is the Europe, well, at the time was Europe's tallest building, opened in 2011 during the crisis. Petronas Towers in 97, world's tallest building at the time, opened up during the East Asian financial crisis. This is One Canada Square in London, again, Europe's tallest building in 1990, opened during recession. 74, Sears Tower during the crisis, and probably most famously of all, the Empire State Building, opened in 31. I believe it was called for many years the Empty State Building because no one could afford to pay the rents in them. So, you know, it brings together all of the elements that I've mentioned about the cycle, about markets, about optimism, about kind of somewhat crazy behavior. And with, you know, I think Oklahoma City, of all places, has announced the tallest building in the US, I believe. You know, you get sort of really odd things like this in the run up to the peak. And of course, what's going on in the Middle East, what's going on in Asia, are examples of that.
You could say the world's longest building, right?
Yeah, there's this sort of NEOM thing and
Like
so
the
on.
10-mile long building or something.
Well, exactly. I mean, you know, who knows how long that will take to get built? But the idea that, you know, you don't announce these things in, you know, in 2009, 10, right? You announce them when things are going on. Other examples. I mean, you got the Taylor Swift $1 billion Eras tour. You've got crazy sums being spent on sports team and so on. I mean, it's actually really interesting times to write about. You kind of really understand where some of these things come from. But we are going to see quite a lot of that. And I think really it seems fairly crazy to me, probably because I'm getting a bit old now, but there is, I think we haven't seen anything yet, to be honest. I think this cycle, it's going to get pushed further than we can possibly believe.